BCom 6th semester, Advanced Financial Account, Financial Management. We have one topic, cost of capital for all universities, PU, BNU, BCU. So now, to start business, we need capital. For that, we have different types of sources of capital. I'll tell you. Source of capital. We have share capital. We need this also from shareholder fund. Preference share capital. For preference share, you know the difference between share capital and preference shares. We have to pay some fixed rate of dividend. Those who are purchasing preference shares. So we need preference shares. I will write simply 10% preference share capital. And we have, for shareholders we are distributing dividend. Sometimes company will retain the dividend meant for shareholders for future use, for capital expenditure, whatever they are keeping. They are not distributing dividend to equity shareholders. Some part they are keeping. That I will call as retained earnings. So this is also same as the share capital. This is also same because for shareholders also we are giving dividend. For that we are keeping that dividend we are keeping called as retained earnings. So then next we are issuing debentures to get capital. Maybe I'll write 8% debentures. Mainly these are the sources of capital. See, we collected these sources of capital. We have to what we are paying to collect these sources. For example, we collected share capital. So we received capital from shareholders. For that we are giving what? Dividend. So dividend means what? That is expenditure for company. Called cost of capital. We get preference share capital. For that we are paying dividend also. That is also cost of capital. Retained earnings, same as it is. What we are giving share capital, same should be treated as retained earnings because both are same only. Then debentures. Debentures is one type of loan. That also we are giving to debenture holder, but not profit. Interest we are giving. So the company is paying interest to its debenture holders. So what company is paying to collect sources, that is called cost of capital. How much they are paying. For example, so we know share capital. Share capital we are giving what? Only dividend. So that is called dividend is called part of a profit. That we are giving. See, for example, if I am issuing the value of each equity shares 100 per share, that is issue price. When the company is in incorporation stage, so I am issuing after 1 year. Maybe we are expecting, not presently we can't distribute profit to shareholders. Later we will distribute to shareholders dividend. So we call share capital. For that what we are giving called KE. That is called cost of equity. For that what we are paying expected dividend. Because exactly we can't say this much rate we are giving after allocation of all. So last receiver of profit is equity shareholder. That's why we don't know how much they are receiving. So expected dividend. So divide by net proceeds. How much we are issuing. So how much we are collected. For example, I'll write the expected rate of dividend will be 10%. The value of equity share 100 I am writing. The face value 100. Rate I am expected 10%. So then dividend should be 100 into 10%. So we'll get 10 only. So 10 divided by face value is what? Issuing price. That much we are collected 100. So cost of equity is 10% only. If we are multiplying with that to 100, we'll get 10%. This cost of equity. See, cost of equity. If we are issuing 100 rupees, for that any cost incur. For example, brokerage, commission, whatever. That we are going to subtract. Here I am assuming there is no issue. There is no issue cost. So directly we are getting 100 rupees. Later we are giving 10%. It is called 10%. If companies already exist, then we can expect. So that expect dividend I am writing as NP. See, if 3 to 4 years, after 3 to 4 years, maybe companies in growth process. So growth. So that's why we are using growth percentage. So G means growth percentage only. If existing company, this is a new company, this is existing company. If growth rate is given, so you can calculate by G only, by adding G. So you get same cost of capital. Both are same. Here growth rate is not given, here growth is given. So there are two cases to calculate cost of equity. That means we are paying, we are receiving 100, for that we are paying 10. 10 is what? Cost of capital. So this is cost of capital related to share capital. See, whatever cost incurred for share capital, same we are writing as return earnings. Both are same only. I said we are keeping some profit for future risk, not profit, dividend. So next part is what? Preference share capital. For that what we call KP. KP is cost of preference share. Same we are giving, both cases are dividend only, but here rate of dividend is fixed. For example, 12%, I will write 12 only. That's why D divided by NP. NP means issue price. So this is same. Dividend means what? Rate is fixed. Before rate is fixed, here that is not fixed. There is no difference between equity and preference shares. Here rate is fixed. See, the difference between share capital and preference share capital, I am telling the difference. So, share capital, there is no maturity period. There is no maturity period for preference share capital. But in all preference share capital, we have to, company has to repay its capital amount. For example, the company collected 10 lakhs. For that, after 10 years, after maturity, in preference share capital that is mentioned, number of years also mentioned, maturity value, maturity period also given. If it is 10 years, after 10 years we have to repay, company has to repay the whole capital amount. So that's why this is without maturity, that means irredeemable. So if maturity value, on that case, if maturity period, then the formula becomes KP. Same for we are giving what? Dividend that is expected. So dividend plus maturity period. P means maturity period. After 10 years, how much we are paying for preference share? PV, P minus. This is after maturity. This is issue price. That's why I am writing as NP, net proceeds, when I am issuing. See, dividend we are giving every year. So that's why. So all dividend should be number of years. How much? If it is 10, so I am writing 10. So N is what? Number of years. Because dividend, interest, all we are transferred to profit and loss account. So each year dividend we are transferring. So we are dividing by N only. Whole divided by P plus P means maturity value. P means maturity value. NP means issue price divided by 2. So this is the formula to find out KP. So later we will discuss about 100%. It is not necessary. This is for redeemable, repayable preference shares. D means dividend, that is mentioned, plus P means maturity value after maturity period. How much we are giving to preference shareholders. If any expenditure incurred for that also we are subtracting. If no, whatever they'll tell after 10 years, preference shareholder or preference share repayable at 10%. That means more than 10%, more than premium. 10% premium is more than that. Face value same as it is, less means discount. So that is given in question. So NP now what we are issuing? NP means what? Issue price divided by number of years, because we are transferring all 1 year 1 year dividend will transfer into profit and loss account. So we are dividing that. So this is average of these two. Average of these two will get KP only. Now last thing is what? Debentures. So debentures we are writing as KD, cost of debenture. For that we are giving what? Interest, I said. So this is fixed. So interest should be I divided by NP. That process same what we are issuing now. See, this all after tax. So dividend we are giving after tax only. Dividend after tax, correct, right? If all dividend shareholders will get after tax. So this is what? Before tax. That's why if in question interest rate is given, so we are subtracting that also 1 minus T. If tax rate is given, if not there, direct line, right? I divided by NP. I means interest, NP means net present issue price. Now what we are issuing. So this is irredeemable. Irredeemable. So if it is repayable, redemption. So that's I am writing. Formula becomes same only. Cost of debenture. For that we are what we are giving? I interest plus same. P means NP. P means after maturity we get same number of years divided by same again. P plus NP divided by 2, because there is no difference between preferential and interest. Preferential, so they will get fixed rate of dividend, but here they will get rate interest. One thing is what? Here this is before interest, though this is after interest. This is before. So we write 1 minus T. See 1 minus T. This is the formula. So 1 minus T. If you want, you write 100 also. All cases we are writing 100 if you want. So 100. Don't worry about 100. So that is percentage only. So this is the formula. Whatever we are getting, that for that what we are giving. So this is cost of capital. So we connected different sources. For that what we are giving. This is all about cost of capital. So how much we collected, for that what we are paying. So together we call it as what? Source of capital. All sources. Combined cost means what? Together all. Combined cost and weighted average cost of capital. Both are there. Weighted average means what? We are taking average of all by giving some weights. So this is the concept of cost of capital. If any doubt, you message in. Sorry.